While most of Wall Street traders are left scratching their heads following Federal Reserve Chairman Jerome Powell's interview on 60 Minutes this past weekend, some professionals are actually out there saying, well, there might be even more to the story. With us today, we have Victoria Fernandez. She is the Chief Market Strategist at Crossmark Global Investments in Houston, Texas. And along with me is Tobin Smith out at Scottsdale, Arizona. Victoria, welcome back to Buy, Hold, Sell.
My pleasure to be back. Thanks,
Victoria,
guys.
I've been demoted. I used to be the co-host. Now I'm just Tobin Smith.
Now you're just a guest.
Yeah.
You are, you're the co-host and you're the gold standard of Buy, Hold, Sell, Toby. So, I'm trying to think of something different than talking about the weather. So listen,
wow.
Victoria.
Hey, Victoria.
Well, let me ask Victoria. I'm going to start with Victoria on this one, Toby, because I saw you were making the rounds last week with the big media channels in New York, and I can't help but notice that your narrative is completely different than what we're hearing from everyone else. Because right now it looks like there are somewhere, I hate to use the word cross again, but there are crosswinds that we have to start worrying about, and some challenges for the rest of the year. Tell us, though, because I got to say, you're actually on the side of not being extra bullish right now.
Yeah, I'm really not. I mean, we look at what's out there and look, I'm kind of old school when it comes to the idea of looking at leading economic indicators, trying to find the red flags that are out there for the economy, things that historically have told us we should be going into a recession. And there have been a mountain of those. I mean, if nothing else, leading economic indicators down, 21, 22 months in a row. You've got this inverted yield curve, 3 month to 10-year, where it's been inverted about 460 days at this point. I did see where the analysts put out saying the average of going into a recession is around 580 days. So 120 more days, 4 more months, possibly. We might see a larger pullback or a recession, but I just think there's too much optimism out in the marketplace, much of it based on momentum, because we've had a consumer that has been supported by stimulus and by increasing wages and the ability to change jobs so easily, being supported by that soft landing narrative and the belief that the Fed is going to cut rates sooner rather than later, at least up until last week, and that there's going to be 6 cuts this year, while at the same time, people anticipating that we're going to have a super strong economy with above trend growth and 11 to 12% earnings growth. So to me, it's like you have pieces of a puzzle that don't fit together. You can't tell me we're going to have above trend growth, 12% earnings growth, and at the same time, the Fed is going to have a need to cut 5 or 6 times for the economy. They just don't fit together. So we're not saying we're extremely bearish, but we're very cautious right now, and we don't buy into the extreme bullish nature that you're hearing a lot right now.
Well, Victoria, I mean, first of all, any of the idiots that are saying that we're going to have a 6th rate cut are, I don't know what they're on. I'd like to know what they're drinking, because I need some of that stuff. The second one is, I am in the camp. I mean, I've been bullish on the economy, since a long time. But I'm in the camp that historical stuff means jack shit after you went through a pandemic for 2 years, and then went through 2 invasions, and now strife in the Mideast. Behaviors change when you get those type of macro global events. A. B, the Federal Reserve has been wrong about their rate cut numbers, or at least the Fed Fund futures has been wrong for 28 years in a row. They have never gotten it right, ever. Even in 2007, Stevie Wonder could have figured out we were going into a recession, and they didn't get it right. So I'm looking at a different, but I'm looking at our portfolio right now. And again, we're heavily in AI. Our portfolio is up 41% in the last 5 weeks. Now, obviously NVIDIA, obviously SMCI, but other guys down the pecking order. And I'm much more about the macro. We've already figured out. You can't have a recession. I'm sorry, you cannot have a recession when you have 78 million people on pensions, when you have 40% of homes owned for cash, when you have rising wages, et cetera, et cetera. 32,000 layoffs in the tech industry doesn't mean squat. There's 1.5 million jobs out there, right? So but I am saying, certainly, we took profits today on NVIDIA and SMCI, and
as you should,
because they were just insane. I mean,
right.
Those aren't professional investors. Those are momentum investors. Those are algo investors. Totally get it. But man, there's still, we see a lot of sectors that we're staying in, making money in. And Todd, I even rebought our LPG shippers today because they finally bottomed out.
Well, transports are actually doing pretty well on a relative basis, so it makes sense to do that. And let me say, under no circumstances are we saying that people should not be in the market. We don't want people in cash. You want to be invested in the market. What we want to make sure people do is exactly what you just said. When you have these green days, when you have these updates, go in there and trim some of those names. Bob Dahl, our CIO, always likes to say, don't be so greedy, right? Get in there, take some off the table. You don't have to come out of a name, but trim those positions and get ready to put them somewhere else. You look at sectors like healthcare. On a relative basis, it is doing phenomenally against the rest of the S&P. Financials have taken a little bit of a turn on a relative basis as well, and are doing pretty good. Obviously, take out what we've seen with the New York Community Bank, take that aside, but some of the bigger banks with those strong balance sheets. So healthcare, financials have been doing good. Industrials have been doing well. Look at Caterpillar. And typically that is a sign of a booming economy when industrials do better. So I don't want to take that away, right? I'm not saying the economy is going to tank. I just think maybe we've gotten a little bit over our skis in some of these when you see how those Magnificent Seven, or now they're taking it down to Magnificent Six or Five, versus the other 496 names in the S&P. There's quite a divergence in that performance. So you have to be selective, but I think now's a great time to step into some of those sectors and pick up some names that maybe have not been doing as well. You'll have more upside on some of those.
Yeah. So let me talk a little inside baseball here, Todd, because people at home have to understand that the average stock market return for the last 40 years has basically been 9 to 10%, including reinvesting dividends, right?
Solid.
If you have a portfolio like ours up 45%, now I'm looking at the number, in a month, what that means is we're in the very right spaces. And what that means is a whole bunch of momentum people that don't buy stocks, they just buy tickers that are going up, are pouring in, and they will pour in until somebody F's up. If NVIDIA misses by a penny, if SMCI misses by a penny, then they're down 25%. And all you have to do is look at, the stocks that just got schmeiced. That's a Jewish word, by the way, for you, Todd. When they get schmeiced for missing by nothing, look at Intel, for instance. So there's like 3 different markets. That's what I'm trying to say. There are institutional investors like our dearly beloved Victoria, and they never buy everything on day one. You build positions, and the way you know you're investing is when you get excited when something comes back in value, because you're not looking at the next day. But if you're checking your portfolio, your portfolio, which is really just your trading account, every 5 minutes, and you're seeing, SMCI go up $76 yesterday. Nobody knew what SMCI was until we put it out in May of last year. Thank you very much. Then you're trading, and don't confuse the trading with the investing. And if you're going to be trading, you better be on your game.
Okay, let's pivot just slightly on this, because I want to go back to the idea of a slowdown in the economy, very slight recession, call it whatever you want, come up with any adjective that you like. But it does make sense, because if the Fed does start cutting rates, they need to have a really good reason to start cutting rates, and a slowdown would make sense. However, on Friday, the jobs number comes out, and it is a blockbuster number. So does that change the outlook for what Crossmark is thinking? Because right now, I mean, even if you cut those numbers in half, it's still a robust labor market.
Yeah, it doesn't change our longer term outlook, because when you look at that number, we also have to kind of dive under the hood a little bit more on this. We know there's seasonality factors that account for some of that gain, not all of it. It was a great number. We have to acknowledge that. One of the things that we're looking at in that report is the productivity, the hours worked, and the wages. So we had hours worked come down. We had wages move higher, which means productivity is moving higher. And this is where we try to connect the dots for our clients. If productivity is moving higher and growth continues to do well, you look at Atlanta, GDP now, it's what, 4.2%? I think it's at it. They continue to move it higher. That means the neutral rate for the Fed funds is actually higher, right, than what it is now. If the neutral rate is higher.
Explain the neutral rate, Veronica.
So it's Victoria, basically, it's going to be that level where you're neither helping nor hurting the economy, right? It's that rate where everyone just continues to chug along, and things do well. If that is higher, that means the Federal Reserve is not as restrictive as we think they are. So I think we have to think down the path a little bit. Don't just do a knee-jerk reaction because we had a great jobs number. What does that truly mean for the economy and for the Fed? Does it mean that real rates are higher than what we thought? Does it mean the Fed is not as restrictive? Does it mean the Fed's going to stay higher for longer and that's the mistake, right? Everyone says the Fed will wait until they make a mistake. Is the mistake going to be they hold too long and then you do really start to hurt the labor market? It's these scenarios that we have to think about. We don't think the economy is going to tank or fall through the floor, but we do think there's going to be some volatility. And we think on those pullbacks, as Tobin was mentioned earlier, that's where the traders step in and really take advantage, make some tactical moves. If you're a longer term investor, you can do the smaller trades, you can trim, you can buy, you can position yourself in companies that will hold their price and hold their value during volatility. But I think we have to really be careful here and not just take every good number that comes through as saying, oh, the economy is great. Let's think about what that means for some of the decision makers in regards to rates.
Okay. Well, let's not also forget that part-time jobs were about 40% of the new ads.
Very important that we saw part-time jobs go higher. And as you know, that is a signal. If I actually was looking at a graph of part-time versus full-time workers, full-time workers were actually on the decline and part-time workers on the way up, along with temporary jobs showing some signals of stress. So those are concerning for the markets as well. But look, guys, it's an election year. Tell me one administration when they're up for re-election that isn't going to try to spruce up the economy, that we're not going to get more stimulus coming in. This is what I think can make our outlook incorrect. I think having more stimulus come in to support the consumer could make it to where you don't see a pullback because you've got all this artificial stimulation going on. Then that just pushes it down the road further and you're looking at next year probably before you see a lot of these elements where you have to pay the piper on what we've done over the last couple of years. That probably comes to roost next year.
Come on, Victoria, you're old school. I mean,
hold on. I am.
Hold on. I'm going to take... Toby, I'm going to take the bait on this one. Okay, let's talk about this stimulus, potential stimulus. Can you tell the audience what that may look like?
Well, we're looking this week actually at some of the new tax laws that are coming out, right? Child tax credits increasing. That's a positive for the consumer. We're looking at research and development components for corporations that would help them in regards to some of the deductions that they're taking. So there's certain elements coming out helping both businesses and individuals exactly what the current administration wants to see as they come near an election. Look, there is a chart that shows there is no administration in the history of the country that has won re-election if there's a recession within 24 months of an election. Never are they reelected. If there's not a recession, they are always 100% reelected. So they're going to do everything in their power in order to help juice this economy. What we're going to have to be careful of, all of these stimulus components that we're seeing, what does that mean in regards to Treasury issuance? Does that push yields higher? And does that cause the stock market some grief going forward?
Well, let's not forget that, there's this world out there, Victoria, and Germany is basically in recession. The UK is in recession. Yep. France, Spain, the Italians are never in recession because they're just hammered all the time. Okay,
they're just happy.
They don't care. But the global, remember, money is fungible, right? It goes to where it's best treated. Right now, it's getting best treated in the United States. The one that really got me was in China. The stock market's only been, bad for 3.5, 4 years. They created these ETFs that own like Japanese stocks, which is doing well, and own American stocks. But the ETFs are selling at a 30% premium to the actual stocks that they own. Now, that's cray-cray. That is, that's out there. But this is the first time I can remember in a long time that there's money coming into the U.S. equity markets. It's coming in a big way from China. It's coming in for a big way. I'm working on the deal right now with G42. G42 is the AI investment group for the UAE Emirates. And they're going to write us a check for $220 million. And they just say, where do I send it? There's more money going into, just not just the United States, what I'm trying to say. We have a huge amount of money going into, what we used to call ESG. Now I just call it sustainability. Right. And we have a huge amount of going into AI. That requires a huge amount of data center and chips and so on and so forth. That it's on a positive feedback loop, Victoria. In my opinion, I can show you the math that more power begets more power begets more GPUs begets more use, and right now we're in that uplift. And oh, by the way, NVIDIA, if you take the forward earnings that we're using, our target's $700. I saw Goldman came out a couple of days ago, $700.
Yeah.
SMCI, we have it at $900. Why? Because on a forward basis, they're going to grow their earnings 125% this fiscal year and then 140% next year. So that makes their PE about an 18. So there's a reason why these, the bricks and mortar, or you want to call it the picks and shovels in the AI space, that have high margins, that have a sustainable, have orders that are booked out for the next 18 months.
Right.
Yeah.
If I'm a portfolio manager, I cannot be not in those stocks. And also, they're the safety trade at the same time. And I can't tell you very often that I've ever remembered in 40 years of doing this, that technology was not only the growth trade, but it was also the safety trade. Yeah, because of all the cash they have. Yeah. And
I completely agree. You have to have exposure to these names. You cannot eliminate them from your portfolio whatsoever. Now, I will say in our large cap strategies, Microsoft is the one that we're most overweight versus our benchmark. We have exposure to all of the names. Some of them, like Apple, we're a little bit underweight versus the benchmark, but you do have to have exposure. I think it's also important, though, in this type of environment where, in our opinion, there's still some uncertainties outside of that group that you're talking about. You have to have that diversification, not just within your equity portfolio per se, but look, you need to have fixed income allocation. If I can get you a 5% yield on an 18-month or 2-year treasury, add a little bit of that into your portfolio to have some steady cash coming in to your portfolio. If you can use covered calls like we do for so many of our clients, write short covered calls, and in this volatility, you can continue to move those and generate income off those premiums. Do that to give yourself a little bit of downside protection. I know you give up some of the upside on those, but it gives you some diversification, an equity market neutral strategy, right? An absolute return strategy, some global exposure selectively. These are the things I think you need to be doing in your portfolio right now, and not just be all in those big mega cap names, although you said the letters AI, right? It seems like that's all someone needs to say on their earnings call for the stock to do well. We saw it with Qualcomm. Qualcomm mentioned how they're going to be using AI. It's a name that we actually like outside of that those mega 7 names. We like that. But we also heard, I said Caterpillar reported earlier talking about industrials. They mentioned how because of all of the AI that's going on, it requires a lot of infrastructure from these companies to build out new buildings to handle a lot of this. And they're benefiting from that. So the AI component really, as you were mentioning, is widespread and flows through. This is what I'm saying, be selective, find some of the trends that are doing well, that have some longevity to them. These are the names you want to invest in. As long as they have good cash flows, I don't want to take that away from everyone. You got to watch those balance sheets. Free cash flow has been one of the most positive factors leading to outperformance. And those names we've been talking about are perfect examples of that.
Yeah, well, let's not forget, Todd, I know you got to go to the break. Let's not forget about farmers. I have some dear friends up in Iowa. You know, a small farm for them is like 4,000 acres, right? He was just telling me this last weekend. 100% of his farming and yield is done automatically. No drivers, no guy running the tractor. All the harvesting, the picking, the sorting, etc. And he says he saves about $1.5 million every quarter because he doesn't have 25 people out picking, doesn't have the fertilizer guy out there, he doesn't have the other type of thing there. So
this is where that productivity comes into play that we're talking about, that 2.7% productivity growth in the fourth quarter. That's where this is coming in.
Deal.
Yeah. All right. Let's leave it there, guys, on that, because just wonderful stuff. And since Victoria did talk about tech, I have to ask her what other sectors she's taking a look at, maybe some individual stocks as well. But we're going to talk all about that in the next break, next block. So with us today, Victoria Fernandez. She is the Chief Market Strategist at Crossmark Global Investments down in Houston. You can go to crossmarkglobal.com for more information.
And her name is not Veronica. I want to say that right now. Her name is
I was going to change it for you if I needed to today. It's okay.
Absolutely. We'll be right back after the break. All right,
Ready to up your game and learn more about the thrilling world of sports betting? Introducing Double Down with Breslow, the ultimate podcast about the business of sports gambling. Join me, James Breslow, and a long list of expert guests as we dive into the art and science of the sports betting industry. Evolving regulations, technology enhancements, and the meteoric rise in the number of players makes this sector the fastest growing and most intriguing in the world. Unlock the business secrets from many of the industry's most recognizable C-suite executives, including famous odds makers and influencers. Every episode of Double Down with Breslow is packed with insider tips, deeply skilled analysis, and in-depth discussions. Don't miss out on the ultimate resource for mastering the business of sports betting. Listen to Double Down with Breslow on the Evergreen Podcast Network or wherever you listen to podcasts. That's Double Down with Breslow, the business of sports betting podcast.
Welcome back to Buy, Hold, Sell. Well, with us today, we have Victoria Fernandez. She is the Chief Market Strategist over at Crossmark Global Investments. And also with me is my co-host, Tobin Smith, who also is the host, the only host, for the new Money Mavericks show that is about to debut in a couple of weeks, where you can watch it on Tubi, Pluto, any other streaming service that you want. It's going to be a wonderful show. I know it's going to. Everybody's on the edge of their seats, Toby.
I know.
For this,
I know, but you know the first guest I want is Victoria Fernandez.
There you go.
I'm there. Just let me know.
Show in Espanol. And just for fun. Yeah.
It'll be a short show if we do that.
It'll be a short show. Hola, ¿qué tal? ¿Cómo estás? ¿Y bien? Sí, gracias.
Well, Victoria is a superstar, and we already know that. And we were just talking about technology. I mean, everybody talks about the tech sector, and why not? I mean, it's a winner, and we know that. But Victoria, I have to ask, name some non-tech sectors that you like.
Yeah, so there's a few out there, and we've talked about already here this afternoon kind of some of the sectors that have had pullbacks earlier this year, and we like to go in and find names there. So financials is one of the areas that we like. We know the balance sheets are strong for the big banks, and what a lot of people probably don't realize is up until last week with the New York Community Bank, prior to that, 100% of the constituents in the financial sector were in an uptrend. And so there's some momentum going in that financial sector. right? We like some of the bigger names. We like Citi. Everyone likes JP Morgan. So we like JP Morgan as well. They're just kind of the creme de la creme of the sector. But Citi had good earnings. They're expecting loan growth like 3 to 4% over the next couple of years. You're getting a 4% dividend with the name. And it's trading 13 to 14 times. So look at some of the names in the financials and see there. So we like financials. We also like healthcare. I know there's been some concern about healthcare. We talked about how on a relative basis, they're performing really well versus the S&P. Cigna is probably one of our favorite names in the healthcare space. There was talk of acquisitions and mergers going on a little bit with Cigna. That's now behind them. The stock has done better since then. It took a little bit of a hit on that announcement. It's back to doing better. But again, if you're looking longer term investments in your portfolios where you can generate a dividend and you have that quality earnings growth, we like Cigna. And then the final sector that I would put out there, and look, you are talking to a Texas girl born and raised in Houston. I bet you can guess it's probably going to be the energy sector. We know the troubles that we have seen from the energy side. And there was always this big debate over the last couple of years. Is it the supply or the demand that's going to drive these names? Obviously, we're having issues in the Middle East, but you look at production here in the US, we continue to see production move higher. These companies have so much cash on their balance sheets. They can do the CapEx that they need to do. We know some of them hold back a little bit. ConocoPhillips is a name that we like in that area. So there are places besides tech that you can go, and not just these sectors. There's specific names in other areas that we like as well. So you just have to be choosy and dig in and find the ones with those strong business models, strong balance sheets, good cash flows. That's what we're looking.
I would throw Petrobras in there as well.
Yes.
Petrobras has stupid cash flow. The dividend we estimate this year is going to be something like 26-27%. Because they have a format of how they have to pay the dividends out because the Brazilian government owns 38%, 39% of the company.
If you can have some global exposure, I mean, that makes perfect sense to put into a portfolio.
Yeah, Equitel, ECO is another one. Go ahead, Todd.
Let's talk about the energy sector for a second, because a lot of the guests that come on, actually Gina Martin Adams from Bloomberg was on last week. She mentioned the financial sector, and that was the first I had heard that. Now obviously you validated also for our audience, but energy right now, let's break that down a little bit. Are you speaking of, I mean, you mentioned Conoco, so it sounds like the big oil companies, ExxonMobil, Chevron, those are winners that you're looking at. But anything else? I mean, maybe Valero for the refineries. I mean, is it the entire sector or just pieces of it?
No, I don't think there's no sector that I'm going to say the entire constituents of that sector are good to go. So Valero, we have exposure to Valero on our fixed income side. We own some Valero bonds there. We obviously have exposure to Chevron and to Exxon. I mentioned ConocoPhillips. Some of the smaller players, and when you look at some of the names like a Cheniere, well, then you're going into lower credit quality in some of these names. And I think you have to be a little bit concerned there. So this is a sector where you really need to do your homework. You need to check and see what are their debt levels? What do those ratios look like? Yes, they have solid cash positions on their balance sheets, but you need to look and see the debt loads. That's something key for these names. Obviously, there's a ton of regulation going on in this sector too, so you want to be mindful, right, of that. But it's the big players that I think we would focus on right now. Once we get past some of the issues that we are seeing currently, the Middle East being one of them, a new administration or the current administration come November, and what policy looks like then, maybe you can start going into a little bit more widespread within the sector, but we would stick with the big names for now.
Todd, I would also throw in
liquefied natural gas. Are we going to hear it?
I'm just saying, brother. Not liquefied natural gas, you bonehead. Propane, LPG.
Who cares?
Yeah, well, here's the deal. If you're in India, I'm just doing my Ross Perot for you, Victoria. Here's the deal. Yeah, India is the largest importer of liquefied petroleum gas, LPG, in the world. 70% of the LPG comes from her backyard, and it is put on a liquefied petroleum gas, a VLCCF large tanker, which we own BWLLF. We own AVACF. Those are the ticker symbols, because if I tell you the names, it's too confusing. And their rates are up about 75% year over year, which means they are gushing cash flow. Today, the dividend on BWLLF, let's call it Beowulf, right, is about 28%, because they pay out 85% of their positive cash flow because they paid off their boats, But then we have this Panama Canal thing that I think people are sort of forgetting about. Mm-hmm. That only February 12th, they start only 25 boats a day. You usually have 62. So because of that, they're going the long way around South America to get to India, or they're going the long way around the Good Hope in South Africa to get to the Suez Canal. Oh, wait a minute, they can't go there either. So all those extra days means that the inventory of ships available to ship LPG are much less. Therefore, if there's more demand than supply, Todd, even you would understand the economics of that, right?
Absolutely.
And look, what that means, going back to what we were talking about in the previous segment, that stickier inflation that I think the Fed is watching very closely. I just don't think we're going to have a consistently downward trending inflation number. I think there's going to be some bumps in this road, which is going to cause the Fed to take a little bit of a pause. And this is a perfect example of the type of thing that could feed through to that. Shipping costs are up 300% over last month.
Yeah,
so very important to be watching this.
Shipping costs, and particularly Chinese New Year is coming, right? So they were trying to get everything out there. Those product goods, they're going to be more expensive. Everybody can't, shop on Taiwan or Shein or whatever those other things are. I will say this though. I also, for my dog next door, I went on Shein. And,
oh my goodness!
I love that.
Yeah, and he loves it too. He barely thinks it's the greatest thing.
Is that the Money Mavericks mascot? I'm just curious.
That could be. And this is what. Listen, buy. That's buy.
Very good.
That's sell.
Victoria, I want to ask you, because you touched on the tensions in the Middle East. Now, flashback here. Toby and I did a show a long time ago on Fox News. Neil Cavuto hosted it, where they talked about when there are tensions in the Middle East, it is an enviable business model, because when they're acting up, oil prices go higher, because there's always the fear that a Scud missile is going to rocket, go into an oil field.
It's called the risk premium, Todd. Risk
premium. That's where I'm going with this, because is there a risk premium? Because I see that stocks like Exxon, Conoco that you mentioned are rising right now. I can't help but think, I know we're bumping up to their earnings reports next week, but do you think that maybe because of the tensions in the Middle East, that is the reason why we're seeing a little bit of appreciation with the big oil companies?
Look, it's definitely a factor, right, Todd? When you have things going on and disruptions to the supply chain, we had the biggest disruption to the supply chain in the history of forever with COVID, and we saw what happened there. So any kind of disruption to that is going to cause an increase in there. But I think add to that the fact that you have OPEC Plus saying, we're not going to increase, what we're producing. Sorry, it's staying the way it is. That adds fuel to that fire. Now, there is a little bit of, buffer to that with the fact that the U.S. is producing more. We're hitting some all-time high levels, but at the same time, there's a lot of concern going on. So yes, the Middle East conflicts and the potential for them to go even further. Obviously, we've seen the U.S. and the UK launch some attacks over the last few days. That's going to add to what we're seeing in the price appreciation there, the risk premium as well.
Yeah, let's not forget that Saudi Arabia needs $87 a barrel to break even on their spending. I'm going to be over in the Emirates here in a month or so, and to get a hotel room in Abu Dhabi, try about $800 a night.
Wow.
I mean,
Well, I've never been, but I'm going to wait for prices to go down before I go then. Yeah.
Well, you have a risk of being kidnapped over there, but that's a whole other thing. But the whole construct for Saudi Arabia is they put $28 billion into an AI fund. It's called G42, and that's why I'm going over they and the United Emirates for some of the projects that I'm funding. Dude, they can't get the money out fast enough. They see AI for what it is. They have the money to put after it. It's coming out of the sheik's pocket, so it's not exactly, he's not begging for money. So I would just add that in there that it's but G42, go to G42.ai.
Yeah,
it's $24 billion of money that the Emirates have put in. They want to own the smart city. They want to own a lot of the healthcare driven in AI. And I'm bringing them a company that uses machine learning, but also molecular modeling with 16 different drugs in phase 1 or phase 2. They're gonna put $250 million in it like it's nobody's business. And then I'll be selling this house and the other house, and then sort of combining together, having a minaret, little cage, because I love those guys. I love their money. I love their money.
There you go. That's right. We all do. Okay. All right. Well, Victoria, I got to ask you one final thought here real quick. I saw you were on Charles Payne's show. We're big fans of Charles. He's a great friend, and being over at Fox Business. You mentioned Home Depot. What are your thoughts on real estate? Because Home Depot, I mean, it's a proxy into that sector.
It is, and we've seen a lot of controversy around housing. Obviously, when rates went higher, we saw housing pull back as kind of that 2 steps forward, 1 step back for that sector over the last year and a half or so. With rates coming down, with the 30-year mortgage coming back down, with a 6 handle where it had been a 7 handle for so long, that's been beneficial for housing. But one of the reasons we like Home Depot, because they cater to 2 different groups, both the professional group and the do-it-yourselfers. I am neither. Don't ask me to fix a pipe. Don't ask me to do anything. I can't do it. But for those that can, Home Depot is really good for that. And coming up on the spring selling season for homes, when we know inventory has been low, this is when people either fix their homes up to sell them, or they just bought a home and they're fixing them up afterwards. Combine that with, and I know a lot of people laugh at this, but look back and you will see the springtime season, people spruce up their yards. It's been a winter, they get outside in the warmer weather. Home Depot typically gets a pretty good boost from their gardening segment as well. So combine all that together, it's a good time to probably get into Home Depot, hold it in your portfolio for a while, and then like we said in the very beginning, when it goes up, you can trim some of it and book those profits.
Yeah, I'm the total Home Depot guy for the garden stuff, for the flowers, man. I get a text from the gal who runs it. It says, Toby, we're going to mark down geraniums 50% because they've been around for too long. I go get them, I plant them, I actually feed them, for crying out loud. And
I just need like a cactus or something that won't die, because I am not talented with that at all. Sorry.
Farmer Toby, I love it. Well, that's great. Well, I got to say, Victoria, you always bring it. You are, first class. The audience loves you, and you really delivered today, and we can't thank you enough. Final question, though. I know you're in CJ Stroud country down there in Houston. Any picks for the Super Bowl?
Oh, come on. I'm going 49ers all the way on this.
Okay.
I have great confidence in that offensive line and Trent Williams to protect Purdy's blind side, and I think they're going to do it. We'll see, but I'm pulling for the 49ers.
Toby, you're a California guy. Toby, what do you think?
But you never bet against Mahomes and Kelsey now that they have a defense that is better than the freaking offense. At least the last 2 weeks ago it was. So
that's true. So it's going to be a good game. It's going to be a really good game, I think.
It's going to be a great game. And I got to say, since my Ravens aren't in it, can I hope for a tie? I don't know. That's why I'm just going for that. So, but we'll see. But listen, we want to thank you, Victoria, for joining us today on Buy, Hold, Sell. Like I said, you were fabulous. We definitely would love to have you back again.
Absolutely. Thanks, guys.
I guess
Absolutely.
flattery will get you everywhere, Todd. Is that really your whole aspect of life?
There you go.
Everywhere.
That's right.
Everywhere.
So on behalf of Victoria Fernandez and Tobin Smith, host of the new Money Maverick Show, I am Todd Schoenberger, and we'd like to thank you once again for joining us on Buy, Hold, Sell. Coming up later in the week, we have Reese Williams, who has some breaking news for the audience. It's definitely a show you will not want to
I thought you
miss.
said Reese Witherspoon. I was like, come on.
No, maybe next week.
Steel
All right, thanks again,
Magnolias. Steel
everyone.
Magnolias.
We'll catch you next time. Take care. All right.
Buy, hold, sell, brought to you by Crosscheck Management.